if you are the first session and if you don't know who we are, I want to give you a bit of background about myself and about TCAE, Toronto Compliance and AML Events. So my name is Susanna Smiley. I have been alongside of many of you fighting financial crime for the past 14 years. And I have been working majority of my career in Middle East and in specific in Dubai. After around a year ago, I joined or I transferred from Dubai to Toronto, and I have been working with one of the international banks and covering their anti-bribery and corruption program for Canada and Latin America. About TCAE, Toronto Compliance and AML Events, we are basically a small non-profit organization. I started this event group around 8 months ago in October last year, and the reason for establishing that was I wanted to make sure that we have all the list of all the events and courses and webinars that are happening in Toronto, and I wanted to create a centralized place so that it would be easier for everyone to access. So it was just the start of the journey, and then after that I have established a new initiative, which is the knowledge series, which now you're all guys a part of now. So the knowledge series is basically I wanted to use this downtime and get benefit from all the subject matter experts and industry gurus to help us, educate us, and help us learn more about financial crime and different topics and different subjects. And with that, 10 weeks so far and 10 sessions every week we had for the past 10 weeks. So I have been very blessed and privileged to have the support of many of you. We started with Toronto. I thought that we are gonna only have people coming in and joining us from Toronto, but you proved me wrong. And now I could see that many of you have joined us from all over the world. So I'm really blessed and appreciate all the support that you are doing for us, and I'm really grateful to you for making the time out of your Saturday, coming in and joining us. So I'm really grateful, and I hope that these sessions have been beneficial to you, and getting something out of these sessions to educate you and help you in the continuous learning. So with that, today's agenda, we're gonna we have a special guest speaker, and many of you knows Bob Kapur. He has been the one and only person who I guess if you have seen him his speeches before, you have been know that what I'm talking about. He's an amazing guy, and he has a wealth of knowledge, and we are so honored and delighted to have him today with us. His session is gonna be probably first part of many to come in, and we're gonna have him for many of more sessions. With that as well, I want to tell you that we might have to have a bit of more time than usual. We might go over more time than 11. So please bear with us, because we have a kind of surprise and giveaway for at the end of the session for you guys, for the people who have been with us for the past couple of weeks. Yeah, stay with us, and we're gonna have some surprises at the end of the session. So with that, I want to welcome Bob. Bob, thank you so much for being with us today. It's really amazing to have you. So the floor is yours. Bob, can you hear me? I guess you're on mute.
Yeah. Can everyone hear me now?
Yes.
Okay,
Yes.
great. Thank you. Thanks for that generous introduction. I appreciate that. And thanks everyone for joining me. I hope everyone's doing well. It's unusual times, but so I appreciate you coming out. You know, I want to give thanks to Susan and her team for the great work that she's doing with the TCAE. I posted on my LinkedIn, you know, if there's one good thing about this pandemic, it's like she said, there's lots of opportunities for the community, the financial crime fighting community, to get together and share insights. I know I attend these sessions pretty much every week, and I hope I can do justice to the caliber of speakers that have come before me. Before I get into today's discussion, I want to thank you all, because I know sometimes you're hearing from different time zones. I'm reading from where you're from, so appreciate taking the hour or so out of your day. A couple caveats. First, I want people to know I'm not a lawyer, so please don't take any of this as legal advice. Second, I'm an independent consultant. My comments today are my own, based on my own experience, don't necessarily reflect the views of my previous employers or any clients. And I think I'm sharing the screen, so I think you can see the Zoom group chat on the one side. That's so I don't have to look at myself, because I'm not sure what my hair is going to do during this session. Uh, I've done a pretty good job, I think, of trying to camouflage how bad it is, but in the back it's pretty unruly. And I'm thinking of doing one of those do-it-yourself haircuts, but I won't do that until after the session. And if it's really bad today, then I might, you know, if the session goes really badly, then I might just try to do it so it covers my face, so you don't have to be recognized. But hopefully it won't come to that. Let's see if I can advance the slide. Oh. There we go. So today I want to talk to you about inherent risk assessments, specifically inherent risk assessments related to money laundering and terrorist financing. So as Susan said, risk assessments in general is a very broad topic. Really, I could talk about just an AML risk assessment, full process. That would probably take 4 hours. Want to be respectful of your time, so I thought, let's just focus on one component, and the first component of that is the inherent risk component. I'm going to provide some general context about what risk assessments are and discuss related legislative regulatory obligations to get the context. But then I'm going to focus on the inherent risk assessment, go through some of the mandatory factors, the optional risk factors to consider, and then talk about some of the next steps and other consideration that you might want to consider for risk assessment exercises. I know we've got some time at the end for questions, so I'll try to make sure that we leave room for that. If there's something that pops up on the chat that's a burning question, you know, please feel free to send it, and I'll try to get to it if it doesn't disrupt the flow too much. First, I do want to get a poll question to get us started. So I think, Susan, you can pop that up on the screen. Okay. So at my institution, I'm involved in the risk assessment in the following capacity: designing it, responding to or completing it, reviewing and challenge testing the responses, analyzing and reporting the results, auditing the effectiveness of the process, or you're not involved in any aspect. So please take a second there. I just want to gauge where everyone's familiarity is with the topic and how they've been involved to date.
Awesome. I'm gonna give another 10 seconds for everyone to just vote. Okay. Let's see the result.
Okay. Okay, so most of you are, it looks like it's across the board, but most of you are involved in responding to or completing the assessment. Some of you are involved in the auditing piece. A quarter of you aren't involved in any aspect. So I think that's good, because I think this will be a good introduction to the topic. Thank you. All right. Okay. Oh, sorry. There we go. So as I mentioned, the inherent risk assessment is one component over the broader components. Basically, a risk assessment is the identification, evaluation, and estimation of the levels of risk involved in the situation. Um, Theory being, by understanding the risks, it arms you with the information that's necessary to properly mitigate the risks. There's a definition there from FinTrack guidance as well for your reference. I'm having, sorry folks, I'm having a little bit of lag on this computer. Okay, so
Bob, do you want me to take over the?
yeah, if you don't mind, Susan, that would, yeah, sorry, apologies everyone.
No.
Thanks. So I'll just assume that you're going to do that. So yeah, we can go to this slide. So like I said, it's a fundamental, I'd say it's the fundamental, the foundation of a true risk-based approach is your risk assessment. And the inherent risk assessment is the first step of that process. So this chart I've taken from FinTrack's risk-based assessment or risk-based approach guidance document. And again, inherent risk assessment is the first step in any risk-based approach. Go ahead, please. So to that end, conducting the risk assessment, it's, number one, as indicated by the fact that FinTrack has talked about it, it's regulatorily required. I'll get a little bit more into more of the details of that later, but I want to talk about some other benefits. And yes, I know I made up the word regulatorily. I'm trying to make that a thing, so please feel free to use that. Giving all credit to me, of course. Like I said, knowing where your risks are, where you're exposed to risks, it allows you to properly address them. But in addition, it also lets you apply your resources more appropriately. I mean, that in that way, you're applying your resources commensurate with the risks that are posed. So this can inform decisions on hiring people, prioritizing initiatives, technology spending. Another key benefit is to provide senior management and the board about the overall status of your program. So you can use that to compare business lines or full organizations, frankly, a risk profile compared to its overall risk appetite. And then you can use that for strategic decision considerations. Even executive compensation can be based on, that comparison of your actual business risk to the risk appetite. And that can be used by regulators and internal auditors to help focus on riskier areas when they plan examinations. Next slide, please. So I talked about the legislative and regulatory requirements. I know there's a lot of international callers on the line, but I'm going to focus on Canadian law, which is the Proceeds of Crime, Money Laundering, and Terrorist Financing Act and the related regulations. I'll just say Act and Regs moving forward. That being said, though I'm focusing on Canada, most jurisdictions do require their entities subject to the AML laws to have a similar requirements, and certainly FATF references self-assessments in its RBA guidance for countries to consider applying to various sectors. So I don't think it's going to be very different. In Canada, the Act requires reporting entities conduct the self-assessment. And that's the citation there. Next slide. Under the regs, the results of the self-assessment are supposed to be used in a few areas. So they should be used in developing your policies and procedures for transaction monitoring, client due diligence, and enhanced due diligence. Those are specifically named. Basically, where high risks have been identified, you need to take the additional measures to mitigate them. I'm going to run through the next few slides pretty quickly because I'll go into some of these obligations in more detail. But the overall requirement for the self-assessment is in section 71 of the current regs. That number will change in 2021 when the new amendments come into effect. A couple key things. Oh, you can keep on that last slide just for a second. Thanks. A couple of things to note. These will be recurring themes throughout. The assessment has to be done, quote, in a manner that is appropriate. So in other words, one size doesn't fit all. It has to be specific to your business or your businesses where you have more than one type. And it needs to consider some of the minimum mandated elements. Go ahead. Client and business relationships, product and delivery channels, and geographic locations of the activities. Next. In addition, the impact of new technologies must also be considered. And that should be considered as it relates to how it impacts any of the other three elements. So for example, if you are looking at a new client onboarding system or new technologies that expand your geographic footprint or give access to more clients, you can give them more access to existing products or services. Digital onboarding technology is a good example. Now that needs to be considered in your risk assessment, please. It's also a requirement that the assessment include all affiliated entities. No, we can go down 2 slides, please. Yep, perfect. The assessment really should be a comprehensive exercise that covers every aspect of your business. And then lastly, the regs refer to other relevant factors, which aren't further defined, but during the presentation, I'll give some thoughts and ideas on the types of things you want to consider. On this slide, the new requirements, I talked about forthcoming regulatory amendments. So there's 2 key changes. First is the enscopement of services in the requirement. Presumably this was added because FINTRAC found that some reporting entities weren't considering non-product relationships to be included in their assessment and ignoring or just not considering the risk that those posed. Example would be, one could argue that setting up an automated bill payment service or automated bill payment isn't actually a product, but rather a service. But it still poses risk, so it should be considered. The other notable change is, the other notable change is the assessment of new technologies needs to be done in advance of implementing the technology. Depending on your organization, you might have been doing this already. It may not be a major issue, but it's now prescribed that that has to be done in advance of implementing technology. Okay. So the regs define what needs to be done, but they don't specify how. Actually, that's good. And for the reason I said, one size does not fit all. The assessment needs to be appropriate for your organization's size, type, nature, and complexity. And it has to address all the aspects of business. So there's really no way you could write a regulatory requirement that could cover every scenario reasonably. So that's why they leave it quite open-ended. There's no timeline prescribed for the conducting of the assessment. Typically, I'd say it's done annually, though it could be done on an ad hoc basis or triggered by an internal or external event. A merger or acquisition discussion, or even a regulatory exam might be something that you use internally when you're notified of an exam. Hey, we should make sure that we've done an assessment. I wouldn't wait till the last minute, but you know, I've seen it done. Generally though, I wouldn't recommend going more than a year, possibly 2 if there were no major changes to your organization, but the reporting of the board, the reporting of the results would typically be done annually to the board. So a lot of times they just go hand in hand. And this is a requirement, I don't think it's written specifically, but it's intuitive. You need to document the self-assessment. That way FINTRAC can actually assess the process that you've used and evaluate the reasonability. Next slide, please. In terms of how to conduct the broader risk assessment process, generally it follows this process. First, you determine the inherent risk. That's the risk that exists before the application of controls designed to mitigate the risk. Then you assess the control environment, the existence and the effectiveness of the mitigating controls. And then from there, you determine the residual risk, the risk that remains after applying the controls. And it's very formulaic. It's, you know, residual risk is basically your inherent risk minus your controls effectiveness. Some places will say it's plus or minus. I would say if you have residual risk that's higher than your inherent risk, that's a sign of a bigger problem. Because you know, your controls environment should not weaken your program to the point where you have more risk. Some would say it's impossible, that inherent risk is theoretically the worst risk you can have. But it should be noted there will be residual risk. You are going to have risk left over at the end. The only way to completely eliminate your inherent risk would really be to shut down your operations. You know, stop new business, stop and exit all existing business. And if you're like me and you like to get paid by your organization, it's not really a sound strategy. Maybe we can go on. I just want to get another poll. I hope that was a good introduction or a refresher for people. Maybe we can just do a quick poll again so I can catch my breath. Self-assessment process is conducted annually, less frequently than annually, on an ongoing basis, right before regulatory examination, or what self-assessment process? just take a few minutes to
Sure. Just giving 30 seconds for everyone to answer.
Sure. In the meantime, I'll also talk. I got a question about what would be an example of residual risk. I'd say any type of activity that's ongoing is an example of residual risk. So you have risk associated with, a client. You put in controls for due diligence of the client, for transaction monitoring. The activity that they are conducting, though, is still an example of the residual risk. It's the risk that exists even despite application of controls, and it's just part of your ongoing operations. Okay. And my institution itself, oh, wow, so many of you are doing it on an ongoing basis. Most of you are doing it either that or annually. That's great. Only 10% are saying what self-assessment process. So that's something that hopefully you'll take at least something away from this from this presentation. Okay, great. Go on. Let's look at some of the inherent risk factors. So this is the first step of the overall risk assessment. So to determine your inherent risk, you want to look at the various risk factors under each of the umbrella headings that are outlined in the regs, the clients, the product geography. There's a lot of ways to do this. A common way is to take the individual risk factor and apply a risk score to each factor based on how it exists in your business. Often the scoring is done low, medium, high. That's probably most common. It could be more or less depending on your organization. I've seen low and high risks only. I've seen some that are more complex, so very low, low, moderate, high, very high. It really, again, depends on the sophistication of your process, which again should be driven by the size, nature, and complexity of your own business. Then you take all those factors into consideration of the umbrella factors, the sub-factors, and then determine the overall inherent risk. I'll go through a couple of examples during this presentation so you can see that visually. But first, let's maybe have a discussion on some of the factors. So the first is the clients and business relationships. This is pretty obvious one. Certain clients pose higher risk because of their characteristics. Examples are nature of their business and occupation. I've listed some of the individual client and business relationship risk factors here that you might want to consider. Higher numbers of clients generally, I'd say, lead to higher risk. The more clients you have, the more possibilities there are that they're using the accounts for laundering or terrorist financing. Looking at the base, is whether the client base is increasing year over year or decreasing. That's also an indicator. The more divested clients over the past year, that's likely an indication that the risk in that business is higher. Obviously, if you're having issues with clients that you're divesting for, MLTF concerns, there's probably something that's saying, hey, your inherent risk is higher too. That's another example of where you have residual risk, the fact that you have to divest clients. Some of the other factors, if you have a business line that has clients with a lot of incomplete documentation, I'd say that's a higher risk category inherently. Higher net worth clients, say, pose higher risks. You might argue that one, but because you might say, hey, not everyone who's rich is a criminal. True, but again, you're looking at the risk, the potential for them to launder money, not the actual activity. So the more money available to launder, the higher the risk that it will be. Obviously, keep back there. Yeah, no, sorry, go ahead. Yeah, the more clients that you have categorized as high risk, the higher the inherent risk. And that's an example of how the inherent risk assessment is intertwined with your separate client risk rating methodology. So that methodology, if you actually apply a client risk rating to your clients or to your client segments, that needs to be really solid if it's going to be used in a meaningful way in your IRA. If it's not, it's necessarily going to weaken the credibility of your inherent risk assessment. So there's potentially some overlap between your client risk rating and your inherent risk rating. And some people say, well, that kind of double counts the risk. I think it makes sense because in the client risk assessment, you're really looking at clients at an individual basis or on a stratified basis. Here, you're trying to look at the overall impact of those clients, those high-risk clients, and the overall impact they have on your entity as a whole. So it may be a bit conservative to apply it at both levels, but I'm pretty risk averse, and certainly I think that if you're going to err on the side of caution, um, ideally it wouldn't skew the results negatively too far, but there are also ways to address that if you think there are, which I'll talk about. Next subcategory of the umbrella is the product, services, and delivery channels. Here you're looking at how clients can use their products, how the structure of products or their features can be exploited. Generally, wire transfers that allow for movement of funds, especially internationally, are higher risk. Where there are lots of large cash transactions, buy-in in itself, in the context of the product feature, well, that poses higher risk. Trade finance products are higher risk, given the potential opportunities for offshore involvement, dual use goods, when we're talking about terrorist financing, movements to sanctioned parties, if you want to consider sanctions in the same assessment, and standard money laundering techniques of over and under invoicing. There are many. Some products, of course, may be lower risk. If you're only dealing in registered products, that area of your business may be lower risk in terms of in that regard. Again, you may have done a separate product risk rating exercise on a comprehensive basis if you have a lot of offers. Or if you do this when you roll out products and services, you might actually do that assessment of that product separately. To the extent that you can incorporate those types of separate risk rating exercises and intertwine them into the IRA process, the stronger and more consistent your assessment will be. Next slide. Correspondent banking, every regulator, this is not a surprise, they'll tell you that it's high risk if you offer correspondent banking services, particularly internationally. You should have at least one high risk business inherently. I think that's just a good rule of thumb. Clients that are relationship driven, where they're solicited and all of their transactions are managed by the bank, I'd say less risky than one-off transactors. Especially if those that can do higher risk transactions without any direct intervention by the bank, those would be higher risk. I think it was on the last slide, I list clients that were onboarded through remote channels and clients that are serviced primarily through remote channels. I think that most regulators consider them to be higher risk than those that are onboarded and services directly by the front line, because you don't have that clean line of sight to what they're doing, or that direct line of sight. I know that some people would argue that onboard remote options and digital ID are stronger measures, but again, I think that's where you're looking at the controls as opposed to inherent risk. And then last, well, not the last one, the third one is the geographic risk. Next slide, please. In considering the geographic risk, you want to look at both the geographic factors of your clients and of your own business operations. Again, to the extent you can, if this can be tied into your country risk rating matrix, or at least informed by your country risk rating matrix, that's a good idea. There's plenty of available resources for a country risk rating matrix. Basel AML index is pretty good. It doesn't include all countries, but it's pretty good. And actually for all factors, the client and product as well, there are various sources that you can use and that are available either through consulting firms. I've seen some pretty expensive attempts at this, which has its pros and cons. ACAMS has a pretty good listing that you can find if you use do Google search for AML or BSA risk analysis. And of course, FinTrack, their RBA guidance documents, they publish those by sector, and they include details of some of the inherent risk factors that you should be taking a look at. Geographically, some of the other factors actually deal with the transaction volumes and values that involve these types of different countries, for higher risk countries and lower risk countries. It can be particularly relevant for terrorist financing component, particularly when dealing with sanctioned adjacent countries, or where terrorist financing activity is known to occur. Go ahead. Most of all of what I talked about, it's driven by hard data. It's very quantitative. So other factors to consider, and I'd say these are more qualitative and would be more of a judgment call by the CAMLO or the AML team as opposed to the data-driven ones. A higher turnover of your AML staff, that's to me poses higher risk. The use of agents, I'd say it's generally higher risk because you can't really outsource the inherent risk by using agents. Um, but again, I talked about that direct line of sight. Agent risk, where we're using third parties to do some of your AML onboarding or other due diligence, that's a, I think that's another risk because of that lack of direct line of sight. Agent risk is an important one, and you need to make sure that you understand that in order to implement the appropriate control measures. At one institution, I created an agent risk rating type methodology, and then we could use that and stratify the controls that we put based on the agents as one of the control measures. The tone from the top. Now it's subjective and it can actually be a bit sensitive, particularly if you're having the business line sign off on the assessment. When I talk about tone from the top, I'm talking about not necessarily the board level, but at the business line level or geographic level, depending on how you're conducting your assessment. Bad tone will likely manifest in issues. So I'd say that's a risk. Where I say the sensitivity comes in is if the CAMLO said, hey, this business has high risk because of the tone from the top, and they're signing off on it, obviously that could lead to some awkward discussions, but I think necessary discussions. If you have concerns, they should be raised. And that's the point of this assessment. And then in terms of documenting these qualitative risks, you need to document them. Because they're subjective, they're not based on measurable, factual, hard data. You really have to document the rationale for the ratings and why you've used that factor. The regulator needs to be able to pick up your document and understand the factors used, the scores applies, and the thinking behind that. And I'd say that's not just the case for qualitative, but if you have the quantitative data factors and your CAMLO is making an override on a score, I think that should be rare, but when they do, that also needs to be documented so people understand it and there's full transparency. Next slide, please. So now you've taken all the factors, the sub-factors, now you need to synthesize them down to an overall inherent risk rating. Again, how you do this depends on the complexity of your methodology, i.e. your business. So let's say your business is pretty simple. You have a few product offerings, small number of clients, small number of locations, businesses. You might do the assessment through a simple questionnaire and document the results like shown on this slide. It would be more narrative. On the other hand, for more complex companies, you might want to mathematize the results. And I know I made up the word mathematize. I couldn't think of another word that really fit. Next slide, Susan, please. So here's an example of it as it relates to client risk component. This is only the client risk. Each of the factors of the client risk is scored individually using these thresholds. And then the averages come up with an overall score for the umbrella category. And then on the next slide, you'll see, on this slide, it's an even more complex version, which applies a weighting to the individual factors. I mentioned earlier that you might think that using one component might skew your results. Well, here's the way that you can control for that. What you're basically doing is you're putting a weighting on the factor as you think that that is more or less important or relevant to your overall rating. So on this example, you can see how the scores in each category are exactly the same as on the previous slide. But because of the weighting, because in this case, the number of clients or percentage of clients that are rated high risk is considered to be more relevant than the average tenure of the client relationships. There's a higher weighted score, so 0.9 versus 0.05. So in this case, the full weighted moderate risk or risk rating for client risk is moderate, whereas the exact same scores generated a low risk score in the previous slide. Each one is valid. You just need to document why you used it and again, why it's appropriate for your business. Next slide. Finally, you're going to take your aggregate of your umbrella categories. So that last slide again was client risk. And then you're going to take the aggregate of the results and come up with your overall inherent risk. So you can use set criteria. For example, if I have 3 of the buckets that are high risk, then it should be overall high risk. You could say 4 lows as overall low, any combination, or again, you could weight this. Say if you think that the qualitative factors are more or less influential than the product risk. Say you have a very limited product offering, but you have a lot of sketchy employees. You might say, hey, employee risk is higher than product risk. Well, then you assign more weight to that factor and come up with an overall inherent risk rating or inherent risk rating. Next slide. This shows what a very complex organization's results might look like. And it can be, it just looks a bit overwhelming. But no matter how you do it, the end result is to have a full picture of the inherent risk of your organization. You can do this by business, subunit, geography, overall. Choose how you want to present it, but you should always include in your reporting, you should always roll up to a comprehensive view. So I'm going to just, again, look over some questions. Maybe you can take a minute to answer this poll. I took a Zoom course and it said in order to keep interest from waning, you should throw a poll in now again. So here's another one. Just going to address some of the questions in the meantime.
I can see the results as well.
Yeah, there's a lot of them here. One-off transactions versus ongoing transactions. So this is an example or a situation where you have clients. So you have certain walk-in clients who do some business. Money service businesses might get this a lot, where they don't have a true client relationship, but they have people coming in and doing occasional transactions. Well, if you have a relationship with someone, you understand their activities, you understand their business, and you have a recurring relationship with them, I think that poses a lower risk than someone who's just coming in to do a transaction. Again, some of it's a function of the nature of the transactions, but I'd say the more you know about the client, the stronger the relationship with the institution, the less risk. I don't understand. Okay. Well, here's a good question, timely question related to COVID. A lot of low risk accounts are moving to medium to high. In this new world, what changes the methodology can be incorporated? Again, I think you need to, that's a good question. I'd say that some of the low risk accounts are moving to medium and high, and I think that some of the previously medium and high risk might be moving lower on the spectrum. So a lot of cash intensive businesses that aren't dealing in cash so much, if large cash transactions is a factor, that takes it down a notch. Some of the other ways, what changes methodology, it's really an understanding your business, understanding what the impact on your organization has had as a result of COVID. And it could be various things depending on, like casinos are pretty much shut down. So if you have a lot of casino accounts, could be temporarily lower risk. I still think it's a bit early to say what the long-term effects of COVID will be on the risk rating of an organization, because I think we're still in the middle, maybe early of the pandemic, and certainly not everything is open yet. I think it's going to be personally about 6 months before we can fully understand all the ramifications. And I'll maybe just do, and another good question. The scores in the inherent risk, are they the same or they keep changing? They change. This is it's not a static assessment. It might be done at a point in time, but your risk factors are always changing. So that's something that's, it's a great point that was raised. Okay, I'm gonna move on. Thanks for the results. I appreciate people are still engaged, so I'll try to keep that going. Next slide, please, Sue. I just want to touch on a few last things. Go ahead. As you know, I talked about the factors that are money laundering and terrorist financing related. There are other instances where you could and probably should do similar assessments. When you're looking at new initiatives of products, money laundering, terrorist financing assessment would be appropriate. And in June 2021, it will be mandatory to look at new technology with an MLTF scope. And my one organization I dealt with, we created a separate assessment for merger and acquisition targets. It was very similar to this one. It wasn't exactly the same, and it was actually a two-step process because we looked at the high level risk of a subject or a target acquisition, and then once we a deal was signed on paper, then we could do a deeper dive, which is very much doing this exercise on their operations, or at least comparing the assessment they've done with their own methodology to make sure that they aligned. It's very good exercise to communicate the risks and plan for them as we went ahead with the acquisition. Then there's other risks that you could look at: sanctions risks, other financial crimes, ABAC, anti-bribery and corruption. I think it's cleaner to do a separate one for money laundering and terrorist financing, because that one is very much driven by regulatory requirements. The other ones, sanctions and bribery, corruption are as well, but fraud and other financial crimes, there's not necessarily a regulatory requirement to do it. It's more operational and prudential. To me, the less that you can hand over, the less extraneous information you can hand over to a regulator when they want to see their assessment, the better. Although I appreciate if it's done by the same, if these assessments are done by the same group, if you have a FRAML or a financial crime unit that does all of your financial crimes, it might make sense to do them at the same time, or at least consider various of the same factors. You just want to make sure that no matter how you do it, your MLTF one meets all the requirements and can be presented to a regulator as showing the MLTF risk as separate and distinct. Okay, next slide. Let's give some final, some thoughts to take away. Data is the key. A successful inherent risk assessment is heavily dependent on data. It needs to be complete, accurate, and consistent for the data assessment to be meaningful. If you have blind spots, where the data is missing or it's inaccurate, try to fix them before you get started. Or you might need to qualify your assessment conclusions and just say, hey, this is based on best available data. There might be issues and the assessment might not be reliable. Not a great position to be in, but at least it's transparent, so you're not delivering mixed messages. I talked about consistency. Again, if you're using point-in-time data, you want to be able to use that same point in time for everything in order to get a true picture. If you're using, historical data from the past year, try to use that same year, that same time frame for the full assessment. Document. I can't stress this enough. Make sure that anyone who picks up your assessment can read it, understand it, how you came up with the model, the criteria, the rationale for overrides, and the scoring. The more you can point to, the easier it is to defend from people poking holes. And it also makes it easier for people who are using the results to understand where they came from. Selfishly, it's also easier to hand off the work to someone else the next time so they can use it like a roadmap. This is a painful exercise, so if you can delegate the work to, if you do it. and this is not one size fits all. It's got to be appropriate for your business, your organization. So experiment with formats, consult with your industry groups and peer groups. What are they using? See if they'll be able to share, maybe not the actual template, but at least the concepts. Consultants that specialize in your sector are a good resource. And consult with your regulator. Get their views on whether they think it's appropriate. Some of them will actually sit down and look at your assessment and say, we think you're missing the mark as it compares to your peers. They might not tell you what is exactly wrong, depending on the nature of your relationship, but they might at least point you in the right direction if they think you're way off. It's better to approach them, I think, in advance and say, this is what we're proposing, than to find out after an examination that you did it wrong. And then you want to use the results. The IRA is the first step, only the first step in the risk-based approach. You need to use your results. They need to inform the rest of your program. Otherwise, you've kind of done this exercise for nothing. I've included some links on the next slide that you might find helpful. I talked about the FinTrack guidance by sector. Wolfsburg FAC on risk assessments has a lot of good information and some other indicators or some other risk factors that you might consider. And then, of course, I'm available if you ever have questions you want to reach out. And with that, maybe we'll take some questions, but in the meantime, I'll say thanks for your time and attention, and appreciate you taking your time out on a Saturday to join me.
Thank you so much, Bob. It was an amazing session. We I'm sure that everyone learned a lot. I learned a lot. Thank you for all the amazing things that you mentioned. So we have a lot of questions. I'm gonna just pause the screen so that we can address some of the questions
Sure.
when we are here. Um, okay, wow, great. Let me get to the questions. Okay, so Claudius is asking, for most smaller MSPs, there always a blur line between low and medium risk clients, especially around their monitoring procedure.
Mhm.
Is this risk category medium really necessary? If yes, what distinct monitoring procedure can you recommend for a medium risk client?
Okay, so I'll take the first, answer the first question first. In terms of is moderate necessary, it doesn't have to be. Again, you can use low and high, and I think that's depending on the size of your organization, that might be fully appropriate. In terms of, and sorry, I'll also say, right, you can also use 3 factors, 5 factors. I'd say 5 is probably the maximum. I've seen some other ones which go, low, low, moderate, 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 high, and then high 1, 2, 3. So up to very high. But I think that gets then you're starting almost splitting hairs. What's the difference between high 1 and high 2? Um, the more sophisticated you get, it's also a little harder to try to demonstrate why that is. But low high is perfectly appropriate. In terms of monitoring, again, this is more on the controls measures, but you do want to, I think the easiest one is to look at your thresholds, right? If you're looking at low clients and saying, hey, we want to look at thresholds over a certain dollar amount or a certain number of transactions. For higher ones, you want to use lower thresholds because they pose higher risks. So you want to take a more scrutinous look at that activity. I hope that answers that question.
Great. Sure. I think the next question is, what are the key things that you look as a part of the AML audit when looking at an inherent risk assessment?
Oh, that's great. So for an audit, I think, again, you want to understand the process that was followed. You want to understand the methodology that was chosen, the criteria. I'd always say, as an auditor, you also need to challenge the data. You need to go back to the data where it came from, the source data, and do testing on, did they actually use the right data? Was it comprehensive? Was it correct? Because that's a big challenge in that is present in a lot of the assessments, is that there isn't challenge data, particularly if the AML group isn't pulling the data directly from systems and they're relying on the business lines to do it. I'd say first, the AML team should be doing that sort of data challenge and pulling examples, but then audit needs to look at the work that they're doing. You also want to make sure that it's calculated correctly. I think a year-over-year comparison is important for audit too, because if there's wild swings, then you want to make sure that, hey, have they applied the right methodology? Or if they've not, or if they have applied the right methodology and there's wild swings, it also informs audit and saying, hey, maybe we need to look at this business line a little bit more, and the AML controls there and the AML groups work within that business line, because there's clearly something that's changing. So audit, I think, has a really important part in making sure that the assessment is meaningful and correct.
Great. There is a question from Sean. He's saying that, is it ideal to have 3 score risk rating or 5? Like high, medium, low, or extremely high, high, medium, low, extremely low?
Again, I'd say it depends on your organization. If it's a smaller organization, very, few products and services, and I'd say that is, or a few geographies that you deal with or that you're located in, low, high might be appropriate. The bigger you are, the more complex you are, I think the more refined that you want to be with your risk assessment. Don't forget, right? You have to use the risk assessment results to uh, inform the rest of your program. So that includes doing your testing, your examining, your transaction monitoring. So if you make it too, you know, too narrow in terms of using only two factors, proportionately you're going to have a lot of high ones. So do you really think it's appropriate to expend a lot of resources and a lot of work on high ones where there might be a group in the middle that you might be doing too much work on, right? That's also a resource management piece. Because no regulator is going to expect, and I'd say on the contrary, they are definitely going to expect that you have some high risk clients. So you can't say everything's low, medium. There got to be some high ones. So it's either low, medium, and high, or low and high. And then you've proportionally got more high risk ones. But ultimately, it needs to be appropriate and reflect your true business.
Awesome. Cool. Next question. There is what is the impact on clients with financial institutions making stringent policy and procedure to fight financial crime? Do you think there is a shift in focus from customer-centric to policy-based banking?
Sorry, a shift in focus from
customer-centric to policy-based banking.
So I'm not, I don't know if I fully understand the question in terms of, I mean, I think that every financial institution is necessarily client-based. And I'd say, in my view, the clients are the ones that really pose, that's where the risk is posed, right? If you have no clients, you have no risk. In terms of, and maybe I'm misunderstanding the nuance of the question. So I apologize to the asker. Maybe if you want to reach out to me offline, we can discuss it.
Sure. There's another question, and we're gonna take probably the last one from here. I work in online gambling firm, and we are witnessing some overwhelming number of new registrants since people are staying at home and due to COVID situation. What additional steps does gambling firms need to take in terms of risk assessment?
I think it's very similar approach. It's just going to be your factors that are different. So your geography, your geographic risk. I think there you want to consider, and a lot of this information is other there's other publications that talk about this, right? So if I were in Canada and had an online gambling operation or gambling operation, I'd say your West Coast clients based primarily on the West Coast or certain countries might pose higher risk. Again, it's really being attuned to your sector and the environment in your sector. I'd say if you have a lot of onboarding in a country that's higher risk, that's a good that's potentially an area that you want to focus on some more. And I think it poses higher risk. Sanctions related, where there's countries that are adjacent to sanctions or adjacent to terrorist financing hotspots. That's an area where I think if you see a large flow of activity in that area, well, that's potentially a good option. And I think your client base is, as you said, is going to change. So that's where you might want to look at where are the people coming in, where are the money flowing, right? If people are putting in a lot of money and taking out that same money without doing a lot of gameplay, to the extent you can tie this into your gameplay, that's another inherent risk factor for gambling operations, right? Because that's the standard technique. You load up the funds and then you withdraw them, and you've got effectively clean money. So I'd say that those are the ones I can think of off the top of my head.
Great. Thanks, Bob. Kind of last questions. What are the major challenges that you believe that the financial institutions have when they are conducting the inherent risk assessment?
Availability of data, I think, is a really big one. Challenge knowing where the data is and how to access it. So, example, wire transfer data. You might have that for screening wires and for monitoring transactions, but if you need a historical dump of that data to determine the volumes and the values that are going outside of the country or coming in from outside of the country, that information, it might be harder to find. So finding it and then being able to get it in a way that you can ingest it for your data crunching. Timing and prioritizing. That's this is a big exercise, and as some indicated, they do this on an ongoing basis. So it's I don't think it's possible to do this off the side of your desk. You need to have to plan for it, and that means engagement of the technology teams and the back office teams, and the data analytics teams who are going to pull the data, and from the business line partners if they're actually involved in the completion. You want to make sure that they are staffed and ready for this work. We used to do a roundtable session where I worked before with the teams and the people involved across the bank, internationally, before we went ahead with the process. And we would walk them through the questionnaire process and changes from last year to make sure they understood what we meant when we're asking for specific data and the timeframes. Those are the biggest challenges. And now, particularly with COVID, the remote work from home situation, skeleton staffs, that's going to be another challenge that I think organizations are going to have to overcome.
That's great. Awesome. So I'm sure that there are a lot of more questions that I was not able to answer, and we are on the top of the hour. I don't want to take much of the time of everyone. We're gonna, I'm sure that, Bob is quite responsive and could answer any questions that you have offline. And so please reach out to him. And thanks a lot, Bob. I think it was a valuable session. I'm seeing a lot of thanks coming in from everyone. So really thank you for all the knowledge and information that you shared with us.
Oh, well, thanks everyone. And thank you, Susan, again for putting this on. Like I said, if you want to do another session on the other components of the risk assessment, we'd be happy to do that as well.
Awesome. So everyone asked me a lot of questions regarding the certificate. Yes, we are going to have the certificate at the end of the session. You will receive an email from us with some questions. You have to answer the questions first, and then you will be able to get the certificate if you pass the test. And about the recording, the session is recorded, and we will share the recording. So so if you want to look into the slides and get the information again, you will be able to do that by listening to the session. And so as I told you, because it's our 10th session and in the 10th week, we're having three prizes and surprises for you. So with that, I'm gonna just tell you that what are the prizes and how we're gonna do that. We start from the third prize. The third prize is a $20 Amazon gift card that we are gonna share with you. The second prize is a $50 Amazon gift card. Because you're all from all over the world, so this is the only prize that we could, hand over to you. And our first prize is the Manchester CF Financial Intelligence Specialist certificate, which is basically, it has 12 models. And Manchester CF was kind enough to offer this for free for our winner with a value of $1,388 Canadian. The certificate will be given to you by the University of New Haven in Connecticut. So so yeah, let's see who is gonna be the winner of these three. So what I'm gonna do is I have put all your names on a wheel, which is like a raffle draw. And I'm gonna share my screen with you and show you how we're gonna do this. So here are all the names that we have, and here is our wheel. So let's start with the third prize. Let's see who would be the winner. So 1, 2, 3. Let's see. Okay. Naveed is going to be our third winner. Navid, if you are there, just give us a wave or just put on a chat box that you are there. Awesome. I'm gonna remove you. Okay, we're gonna go to the second prize. Awesome. Okay. This is our winner of the second prize, and now we're gonna go to the first prize. Who is gonna be the winner of the first prize? I think everyone is excited. Okay. Let's see. Mark, that's awesome. Great. If any one of you guys, the winners, Naveed, Hitesh, and Mark, if you're there, just let us know. I'll be contacting you for your gifts and prizes. And yeah, congratulations to everyone who were the winner. And I want to as well thank the Manchester CF for giving us this opportunity and share this valuable certificate to us. It is an amazing course and I really enjoy. I'm doing it myself as well. So I hope that, Mark, you enjoy it. Awesome. So thank you guys. Thanks everyone for joining in, and it was a pleasure to have you all with us in the past 10 sessions. Thanks, and have an awesome weekend. And thanks again, Bob. It was amazing session. Thanks. Thank you guys.